Hey everyone, my name is John deRoulet. I'm the head of revenue management education here at Wheelhouse. And today we're going to be doing a deep dive into data in Long Island and the Hamptons and Hempstead. These data deep dives are an opportunity for us to look at market data and have a conversation about strategy and what we're seeing. This is obviously going to be the top high season in the market for this time. We want to make sure that you're best equipped to have conversations with your owners, to be able to see and compare what's going on in your own portfolio, and to be able to strategize based on what's going on right now. So really look forward into diving into this data with you. Now, before I get started, I did want to do a little plug on our product, but don't worry, I won't stay too long here. We're going to be using Wheelhouse market data for this data deep dive. I'm going to be talking a lot about things like occupancy and pace, and I wanted to let you all know that if you don't have good business intelligence tools to easily see your own pace, easily see what's going on in the market, Wheelhouse does offer these tools. Not only that, we offer them for free. So our entire business analytics suite that will help you identify how you're pacing compared to last year, how you're pacing compared to the market, and easily roll up and down across multiple different groups of listings and filter down into different categories. That is totally free, and we do offer training. If you'd like access to this performance insight tool and you'd like some training on process and how to use it, shoot us an email or give us a call. We'd love to chat with you and get you set up. Okay. So today we're going to dive into market data using primarily the Wheelhouse market reports. Wheelhouse has a few different places where you can get data, and market reports are an easy way and a great way to kind of start out because they're going to give us high-level trends that go through kind of, what's going on at a general level. These are going to be a little broader, so you can see I do have this Hamptons market pulled up. And we are going to be seeing, looking at kind of a broad area. We do have some tools to look into more in-depth neighborhood data, but for now, we'll just start at the big trends so we can kind of talk about what's going on. Before we jump into that, though, I do want to talk a little bit about some news that I think is relevant. I try to do a little extra research before doing these data deep dives. Often I'll look into DMO data, CMO data, and stuff like that. And I think, I didn't see a lot of great data across Long Island that's being produced by the governments or the municipalities. However, there is a big piece of data, news in the space that I think is relevant to you guys and relevant to most people kind of in the Northeast area, and that is Canadian travel. If you've been following the news, Canadian travel has been down quite a bit. I did pull up a recent article. This is very recent. This is from June 10th, 2025 in Forbes, and it's basically saying inbound travel from Canada to the United States is down nearly 40%. So major, major drops in inbound Canadian travel. Now, other international travel is being impacted as well, but the Canadian one is really driving a lot of drops in our international travel. This is going to be really important if you or your market area, if Long Island is exposed to this kind of travel. We see a lot of Canadian travel across Northeast markets. Off the top of my head, I'm not sure how much this is going to impact Long Island, but at the end of the day, what we're looking at here is significant declines in air travel, even larger declines in car travel. And every month has dropped more and more and more since, March and April. So they have a few good data points here. Even a 10% drop in Canadian inbound tourism is equal to 2.1 billion in lost spending across the country. We're seeing pretty substantial drops, and they seem to be getting worse. So this is something you really want to look out in. If you go into your CRM, you look at your market data, you really want to see if you are exposed to Canadian travel. If you know that there's a big Canadian contingent in your market, it means you really need to start strategizing now because those consumers aren't necessarily going to be replaced by other consumers. In addition to that information from Forbes, I do have some data from Cleveland Research. Matt V sent it over to me, and I think it's pretty interesting just to kind of pile on and give a little more context. This is going to be nationwide data, but as you can see here, Canadian arrivals, which are down quite a bit, make up over a quarter of foreign visitors to the U.S. So that's a pretty substantial chunk of visitors at the U.S. level. But even looking here, we see general overseas and international arrivals are down too. Even, we have a little bit of a flip between March and April, probably due to Easter, but net, we're down 2 to 3% across the board. So you really need to look and see if you're exposed to international travel in your CRM and in your portfolio, because it's really going to impact what you have what revenue strategies you're going to do to respond to what's going on in the market. In addition to that, you also need to be aware of, even if your portfolio isn't exposed, you need to be aware if there are people in your market who are exposed, because if they're extremely exposed, their pricing strategies are going to reflect that, and you're going to have to compete with them, even if your own portfolio is not necessarily at risk. Okay, so let's hop into some of this Wheelhouse market data and see how the markets are actually performing across the OTAs and across the direct data that we have. So I'm back on the Wheelhouse market report, which is a great spot for us to kind of see these high-level trends. I'm actually going to go over here and click on the trends section, and we're going to sit on this adjusted occupancy trends visualization, which I think is a really great visualization to be able to get just a high-level analysis of what's going on in the market. It is going to show us month over month, year over year, occupancies or whatever KPIs we select. And in this case, we're going to look at occupancy because I think it's, occupancy is something that's going to be really good for us to just get a high level snapshot of what's going on, right? Not only is it kind of like controlled for the fact that there's a lot of different room types where, if we're looking at rates, ADRs, we have to kind of consider the specific groups we're looking at, but it's going to give us just a really good idea of how demand is in the market based on how things have been performing. In addition to that, adjusted occupancy is a great chart for communicating to owners, right? Owners aren't always going to have the time or the space to understand the nuances of what's going on, but they do understand if occupancy is up or down and the implications of that, right? Now, you might have to give a little qualification and talk about what's going on the rate side, but for the most part, like, occupancy is something that owners can consume. It's something that your team members can consume, and it's a good way to just get a quick idea of what's going on. If you like the visualizations here, these are actually accessible for free, so anyone can come in, access any market report as long as they have an account on Wheelhouse. It doesn't have to be paying, and you can get this data yourself. So the first thing I'm going to do is I'm going to turn off 2023 and 2026 for right now. For now, let's just look at the year over year kind of performance in the Hamptons. And the first thing to note here is, you guys will know this, but primarily speaking, majority of your revenue and demand is coming in the summer. It's a pretty short season, and this is something that's pretty common across Northeast markets in particular, that there are very, very short seasons. That means a couple things. It means all of your eggs are kind of in one basket. You have to make your money right now. It also means that there's very limited opportunities to kind of extrapolate from earlier months how things are going. You can see here at the market level that occupancies across January to April and even November and December are very, very low. Most people are going to be vacant at that time anyway, so you can't really use that easily as a bellwether. I usually recommend that people who are in highly seasonal summer markets like this that don't have a strong spring, spend some time during the spring and winter listening to what's going on in the markets that do. So if you look at markets that have a high season in spring, that's going to be like urban markets like Phoenix, Arizona, Nashville to a certain degree, Miami. Kind of seeing what they're seeing from their demand perspective can give you an early indicator of how the year might be wrapping up or coming together for the consumer. Another place to look is when you look across the Southeast coast, particularly when you get down into Florida and Alabama and Texas, their spring break periods in March and April can be very strong. And understanding the sentiment that they have about spring, you can kind of potentially pull some of that forward or make adjustments to your pricing strategy because you might be able to extrapolate some of those trends to yourself. Now, they're not going to be apples to apples, but if you were paying attention this year across the Southeast, you would have heard people say, hey, it's a really tough year. Pickup is not coming in the way we expected. The booking window is way shorter, but we're doing it at a lower rate. Those are all things that can inform how you're going to treat your high season coming up, because even though they're not the exact same markets, we are in the same macroeconomic kind of situation. So looking at this Hamptons data specifically, there's a few things that stick out to me, other than just the general seasonality of the market, of course. One is that pretty much every month this year, there's been attrition in the occupancy, meaning less people are occupied, there's more vacancy in the market. Now, in the lowest season, that's pretty negligible, so there's not much we can tell there, especially because so few people are booked. But as that kind of rises historically, March to April to May, we start to see that deviation spread, right? March looking pretty weak. Now we could be able to write that off, say Easter's moving, maybe that's changing the demand, that makes sense. But as we get to April, we actually see that deficit grow. We don't see any of that occupancy made back up for Easter. So early on, as early as March and April, we're maybe getting indicators that there's some potential weakness in the market, right? Because there's a lot more vacancy. Once we get to May, we see that spread continue to widen the gap. We have continued attrition in the market, and this should be a really big red flag as we enter May that the market is really consistently starting to underperform. Now the question is, what happens in the summer? We see here that June occupancy gap is widening further. This is a really, really big red flag. We're pretty much the end of June now. We'll probably get a little bit more occupancy on the books, but not very much. And hopefully a lot of you were making some adjustments in June and not just waiting till the last minute. But we now have 1, 2, 3, 4 months, all with different seasonality, kind of indicating to us that the market is under a lot of pressure. And with the market under a lot of pressure, it means that you really need to be making adjustments further out. You really need to be looking further out already, because you're going to have to compete if you wait until the last minute with all the other people that are missing occupancy year over year. Now, when we get into July here, you can see we have about 23%. So we're about a third of what's on the books. Right off the top of my head, that seems pretty low to me. I think like if you're under 50% of what you did last year, the market's probably trailing quite a bit, right? And even trying to book 50% in the month, you have to be a very short-term market for that to happen. Keep in mind, we're looking at all listings, so that includes small listings and big listings in the Hamptons. And so that's a pretty risky occupancy level to start the month in. Now, one of the things to keep in mind here is we're just looking at the current year occupancy, the current occupancy right now, and where it ended last year. So the question is, where was this pacing last year? I went ahead and pulled some of this data up. We don't have it directly here right now, but we can access that by going to these historical charts. We have distribution charts. And using this, I can see how much was on the books at the time and do a little math to get to our general pace. If you're wondering why we don't show the pace, we actually are in the process of just showing that explicitly for you, so that should coming out soon. But for now, I did that research for you, and at this time last year for July, the market was at 40% occupancy. So there's almost half on the books across the market level than what we had last year. So the market is under a ton of pressure. Going over to August, we're at about 10%, so we're less than a sixth of the way there. At this time last year, we were at almost 30% occupancy, so substantial pacing trailing in market level for August. And August being as strong or stronger than July means there's a big risk here of vacancy. What you have to do in your own portfolio is you need to look at your pacing, right? I can tell you kind of what's going on at the broader market level. What this is telling us is that there's actually a lot of competition available, that we may be seeing people start to panic with the rate, especially if they're not looking too far out. And that may make the rate situation very competitive. Prices could start to collapse or drop very quickly in the market. Now, you do want to check your own pace against this. If you're pacing fine, that's really going to impact what you do. You may have an expectation that prices will drop. It means you need to really watch your pacing, because if there are any changes, you need to make some adjustments, but you may not need to panic. If you're ahead, same thing. But if you're behind in pace, you really need to start making some moves, because you know that other people around you are also behind, that there's going to be a lot of properties available for the consumer to choose from, and that the pricing might collapse. So, the kind of rule of thumb is July is probably a little late to make some minor changes. It's probably time to hit the panic button for July, because we're within 35 days of the end of the month. August, we still have some time. We're in that 60-day window. You can make some slight adjustments to try to get pacing, but really still you only have a few weeks. Ideally, you'd want to start to see early signs of this in April and May, so that you can make smaller adjustments, manage your pacing, so that you don't have to try to compete with all of your inventory at the last minute. Okay, so one other thing I like to check here is I do like to check the highest performing listings, just to see if there's difference in trends. The trend I'm seeing here is generally pretty similar, but we do see some differences. For one, the overall occupancies are much higher in the highest performing listings. I think that makes sense. There's a lot of different kind of product, professional, non-professional in the marketplace. And when we look at the top performing, 20%, overall occupancies are generally significantly higher. We do see some slight trends here. While pretty much all months are still experiencing attrition, they're not experiencing as much attrition, right? We see the loss in March. We see actually a little bit of a bump back up in April, though it's still an overall loss year over year. May and June are down, but not down as much. And when we look at July, it's still pacing behind, but that pace is looking a lot better. We're close to half, not quite at half, but definitely above the kind of third we were at compared to last year. So these high-performing listings are still trailing. It's a big red flag. It means that everyone in the market's feeling the pressure. What's happening in the market isn't really kind of like making up for this loss, although those top-performing listings are taking a larger market share. Now, the next thing I like to look at is asking rates. Asking rates are a data point that's kind of going to show us the average of how listings are being advertised in the market. So rather than look at ADRs, which is showing how things are actualizing and is going to include stuff that was booked way in advance, this is just the averages of what people are putting out there from a pricing perspective. And kind of interesting here, you can kind of see that in general, pricing is pretty stable year over year. There's some slight increases earlier in the year, but it seems like as we've gotten to summer, that's mellowed out. But people aren't being too aggressive with their ADR and aren't pushing their ADR year over year too much at the market level. Now, that is a little bit of a mismatch. We're seeing a lot of pressure on the occupancy side, and essentially what this is saying to me is while the market isn't pushing rate, it's also not responding very quickly to the fact that there is a lot more competition. There's a lot less occupancy on the books, and people, the customer has a lot more choice, because we're still seeing slight increases of the rate, especially as we go into July and August. Pretty minimal, but still there. The market's not really responding to the fact that pacing is down. And then once we get into September and beyond, we see very little attempt to be competitive in the rate. There's honestly just like a far future premium, almost like we're looking at COVID, where people are just post-COVID, where people are keeping their rates high. And honestly, that's a missed opportunity. If you're finding that you're really trailing in occupancy, that your pacing is poor, this does present an opportunity. It means that the market at large really isn't pricing very effectively in the fall, and you might be able to just take market share. Now, obviously, those months aren't going to be your big money-making months, but if you do have vacancy, you do need to make up revenue, any market share that you can take in the fall could be a good way to kind of like boost your year. And because the market really isn't paying attention to pricing out here, particularly September and October, and maybe even a little bit November, there's an opportunity there if you just get your pricing in line, probably more in line with historicals, maybe even undercutting a little so you can just stack on more occupancy to make up for the fact that there are shortfalls. Now, if we look at the highest performing group in the market from a pricing perspective too, I like to glance at it, but honestly, we're not seeing much of a difference in trend. There is a bigger difference in price, right? So already you can see that the lowers are a little low, the highers are a little high, and the high performers are a little more dynamic in general, but still generally pricing near or slightly above last year, still pushing price a little bit in the summer. That August pacing looked really bad. They might be being a little too optimistic here. And again, not really paying attention September and on. In this case, I think that we'll probably see pretty big switches here as June actualization comes in, because this market doesn't have a big opportunity to kind of see performance in the spring and extrapolate forward. Unfortunately, that time where people are going to react is very compressed. And really the takeaway here is you really need to find ways to see early how market conditions are going to affect the summer so that you don't have such compressed trends and can kind of try to stabilize your pacing a little further out. In addition to that, it does seem like whether it's at the market level or the highest performing group, the market is just not quite reacting to the trends that are happening in occupancy that quickly. So for you, there's some opportunities to maybe make stuff up in September and October. August still has quite a bit of time to make some moves, and you should probably start making some moves now. In July, you really need to make some moves, especially if your own portfolio is pacing behind. All right. So let's hop into our next market here. I've got the market report pulled up for Long Island. So you can see here, when you look at the map, Long Island is separate from the Hamptons in this kind of setup. We were just looking at this Hamptons area. Now we're looking at Long Island. Long Island, this kind of market area, is a lot smaller in general. And let's hop over here to the trends, and we'll kind of look through the same overall kind of perspective that we were looking at with the Hamptons. So I'm going to pull off 2023 and 2026, and we'll just kind of take a look at what's going on. Obviously, those seasonality trends are going to be really similar. We're making most of our money in the summer. Spring is a little bit lower. Now, we do have kind of a similar trend as well. Pretty much consistent attrition, March, April, May, and then into June. We're seeing a lot of pressure on the occupancy side. That means there's a lot more homes going unbooked than we've seen in the past. Now, when we look at July, we're almost about 50% there. So, pacing kind of okay, but not great. It is below last year, though. At this time last year for July, we were at 42.2% occupancy on the books. So almost half. That's a lot of pressure at the market level. So looking very similar to the Hamptons in the sense that the pacing this year is very, very poor. We're within 30 days, so there's very limited time to actually adjust. It means really what is happening in your portfolio is going to have a major impact on what kind of actions you take. If you're pacing really behind, you should be aware that other people in the market are pacing behind. It probably means that rates are going to keep falling very quickly. So you need to make big changes and be on top of it. If you're pacing pretty well, you might be able to keep going, but you need to watch your sales pace very, very closely. Because if there's changes to your sales pace or that starts dropping instead of maintaining or increasing, you might need to go in and make big changes because the market around you might be moving very quickly. Now, small plug here, if you don't have access to good tools to see your own sales pace or where reservations are landing on your calendar, let Wheelhouse know. We offer our Performance Insight tool for free. And it is a great tool to be able to quickly see that. We're also happy to provide you training. Shoot us an email and we'll get you set up on that business analytics so that you can very easily see on a week-to-week basis or a day-to-day basis how you're pacing. Now, when we look at August, we're also pacing behind here too. At this time last year, we were at 27%, roughly 27%. It's not an exact science the way I'm doing this. But that puts us a little less than halfway for August. So overall, we're not looking super strong in the market. However, August has a lot of time. We do see that booking windows are pretty short. And there is an opportunity to capture more occupancy, but honestly, you should start making those changes now. Now, let's take a look at the highest performing group just to see if there's some difference in trends. Mainly not too much other than the fact that occupancies are generally higher. We still see this attrition through the spring and into June. We still see us being little less than 50% of what we had on the books in July, although I do think that that's looking slightly better in terms of pace. But overall, the entirety of the market's under pressure. Now, let's pop over here and take a look at the asking rates real quick. So if I look at just this year to last year, we do see a little difference in trends. Whereas in the Hamptons, rates were pretty stable year over year. In Long Island properties, we're actually seeing people in the market keeping their rates a little bit higher. And again, this is a pretty big mismatch, right? A lot less people are being booked, and we're not seeing the market react very effectively to try to capture or compete for the occupancy that's there. That means the market is really abdicating to the consumer, just the choice of whatever property they want. You also may be losing opportunities because in environments where there's occupancy under pressure or maybe the consumer doesn't have as much money, they're going to be much more likely to look at other markets that are nearby. And if those markets are being very reactive to the consumer, then they'll just go travel there. The fact that this market is generally pricing above what they were doing last year and not really responding to the occupancy means that there's potentially some missed opportunities here. It does also indicate to me that competition in the short term is going to be really difficult. And in a way, it's also an opportunity, right? Because if the market in general is overpriced or pricing higher than it was last year and not following occupancy trends, that means you, a savvy property manager or revenue manager, have an opportunity to really push adjustments in the market and try to capture as much market share as you can. You may not be able to make more demand appear in the market, but you can get a higher share of the demand that is occurring. In addition, we do see here from September through December, again, the market is really just not looking out more than 60 days. So that's another big opportunity. If you can really position yourself competitively, take a look at what properties were, not booked last year and price them super competitive, because that's just strong year over year revenue. if you had properties that were booked, look kind of the averages of where they were actualizing and price closer to that rather than just keeping the price high. And you can really potentially take the market share or any market share that's looking now and add that to your bottom line and your top line. Now, let's take a quick look at the highest performing listings in the market. We did see that overall occupancy was higher here, that there was a little bit better pacing, but still under pressure. And what is interesting here is you do see a difference in behavior. The top performing listings held their rates a little bit in the spring, but once we get into June, July, August, they're actually starting to undercut what they were posting last year, this year. So you can see at the top echelons of the market, they are being much more reactive to the market condition, right? They're looking at the pressure in the market. They're saying, hey, we're going to have to give up on ADR. We really need to focus on taking as much of the market share as we can because there's not as much to go around. And they're actually dropping their rates already in June, which makes sense as the end of the month. July, they've already gone below, and even cutting as far as August and saying, hey, we're not going to try to push ADR right now. We're going to try to make our money by getting as much occupancy as we can. What that means is for an individual owner, they might make a little less if they remain booked. However, more owners are going to have more revenue on the books, and I think that's a pretty good trade-off, especially when you're thinking about your portfolio. Again, though, we're still not seeing users be very competitive or people in the market being very competitive past September. So we're still kind of stuck only looking out that 30, 60 days. And I do think for anyone who's really been pacing poorly or needs to make up some revenue, spending a little time to focus on getting your pricing strategy for the fall in place would be really helpful for you. All right. I hope you found that market data helpful. I hope it gives you some talking points that you can use with your owners and also informs the revenue strategy or where you need to spend some time or where you can look in your own portfolio. Feel free to share this out with people if you need to give your owners or anyone you know kind of like a perspective from outside of your organization on what's going on in the market. And I talked a lot about pace, right? Pace is really important. I'm talking to you about the market pace, which is really important for you to know so you can kind of have an expectation of what's going to change. But the missing piece here is your own pace. You need to know how you're pacing because that's really going to affect the kind of decisions you make, how often you're going to look at stuff, how much you're willing to cut if you're going to cut at all. And having access to that data is going to be super key. If you need a tool where you can very, very easily and quickly see your own pace at the daily level, you can see exactly what days are selling, exactly what days are stalling. If you can see exactly what days are pacing ahead, exactly what days are pacing behind. If you need a tool like that so that you can easily roll that up across your 2 bedrooms, your 1 bedrooms, your whole market, single neighborhood, let us know because we are offering our Performance Insights tool for free for everyone. And we are offering free training on how to get set up on it and how to implement processes to check this on a weekly or monthly level so that you can keep in touch with your own pacing and not suddenly realize, hey, I'm behind and the market's behind and I only have a few weeks left to fill. Let us know if you'd like to get access to that. Otherwise, if you have some questions, please reach out and look forward to seeing you again soon.